Good day, fellow investors. Nike stock is trading at cycle lows. Bill Ackman just doubled down on Nike as he acquired 3 million shares in the earlier quarter and now another 13 million shares. And he's now a little bit into politics, but he sees accelerating growth of the country. And if there is growth, also Nike should return to the growth trajectory it had once. And you can see now it is trading below trend and at almost decade lows for such a strong company, such a strong brand. Plus, the P ratio is getting closer to 20, far from the S&P 500 30s. Thus, Nike, given the strength of the brand, looks like a relative cheap buy, and that's likely also why Bill Ackman is starting to buy, because he said that he likes to own great American businesses at a fair price. And if you want a fair price, that's what you can get now from Nike. This was clearly exuberant as we discussed, but now we are significantly down 60-70%, and it's time to discuss Nike. And as they say about themselves, hopefully they will still be a growth company, and therefore despite the 10% decline in quarterly revenues, the plan and the management efforts will be for Nike to continue growing. But they were down 9%, 10%. They guided that decline as they are a little bit switching their strategies. However, there are still dividends, there are still share repurchases, and now these share repurchases look much better as the stock price is down. And if we look at revenues, of course, it has been a growth story with the recent decline. But if you look at things before, let's say, the pandemic boom, then we can see that the trend is of continuous growth, and it will likely grow alongside the market's sports growth. Plus, it is a great brand. Maybe these were exuberant profits, but if you again look at from a lower level, we are now at 5.3 billion, the trajectory is there, and it could be very likely that this is something temporary. In the meantime, they're repurchasing stocks, they are paying that dividend, and that should drive the long-term returns. The long-term debt for a brand like Nike is actually down and not that relevant. So yes, margins are getting squeezed a little bit. That leads to lower operating margins. These were really extraordinary times, but the normalization is something we have to look for, and then also value the company in a more normal environment. Let's look at the conference call, because there you can see what the analysts are asking and what the management is saying. The last conference call, there was a change in CEO, so there is no CEO at the call, but they have cancelled their guidance, and that is always a shock for the market, something that sends the stock lower. It is about also knowing what will happen next. They went down 10%. They said the next part of the year should be better, but if it isn't better, then there will be another hit on the stock price. But they have cancelled guidance, so we'll have to wait and see what happens there. This is from the previous guidance, down mid-single digits, with first half down high single digits, which is now at 10%, and then should be better in the second part of the year. We'll see whether this will happen, but there is a clear shift also in strategy. In a previous video that I made on Nike, the conference call mentioned Air and Air Jordan and Air this and Air that 47 times. In the last conference call, Air is mentioned just 5 times. They are, yes, working on innovation, but maybe the Air brand isn't selling as good, so they are now focused on innovation, and they say that takes time to transition. They are trying to bring a new dimension to these classics, and they say they have created a large amount of consumer demand, but revenues are down 10%. And I just watched a nice video from Casey Neistat, Do Hard Things. He ran a marathon under 3 hours, and this is what he used to do that. That's a Brooks shoes. Who owns Brooks? Berkshire Hathaway, Fruit of the Looms. Warren Buffett is also competing with Nikes. I think the key risk here is, okay, Nike, yes, the brand is there, but the competition is also there. Brooks, others running this and that. There is so much money entering the apparel market, the shoes, that one might question whether Nike's 2-3 years ago boom will again replicate itself. It's likely somewhere, yes, the stock will double as soon as you have 4 quarters of beating expectations. Then that's maybe also what Bill Ackman is playing on. He's not yet discussing why he bought it. We'll have to wait for that. Don't worry, tomorrow there will be Brookfield Corporation. Let's put Nike into our valuation quadrant. We have 5-6-ish billion in net income. That's the P ratio there, around 20, the market cap. I think that if Nike continues to grow with the market, that's already 4-5% plus 3% growth. Still a little bit of headwinds or something like that, but we are at 6 very conservative 7-8% growth rate, and that's exactly maybe what Bill Ackman is investing in. I have put now here Nike. Perhaps it should go a little bit here. Let's say much better than the rest of the market and much better than the very expensive stuff on the market. So Bill Ackman is positioning here. If it gets priced again like the market, that could be a 2x on improved fundamentals. So yes, much better than the market. And if you buy great American businesses, it's hard to not buy Nike now at this moment in the cycle. The risks are, of course, there if the downtrend continues, but the downtrend compared to the last 2 years that were booming. The long-term underlying trend will likely show for more growth as people buy more shoes. There will always be ups and downs, and we'll see how Nike deals with it. But the cash flows are already there now. Tomorrow, Brookfield.